Welcome to the deep dive. The stock market often feels like this incredibly complex thing, right? All jargon and flashing numbers. But today we're going to try and cut through some of that noise, pull back the curtain a bit, reveal its core functions, and really why it matters to you.
Absolutely. And it's more than just finance talk. Understanding the market means grasping a really fundamental part of our economy. It touches everything, innovation, company growth, and yeah, your own personal wealth building too.
Okay, let's start right there. We hear stocks all the time. But what is a stock, really? What does it mean to own one?
Yeah, good question. Simply put, a stock is just a small piece of ownership in a company, a public company. So
Okay.
when you buy a share, you're actually buying a tiny fraction of that company's future earnings, its assets, everything. It's kind of cool. You become a part owner, sharing in the potential gains, but also, the
A
risks.
part owner. Okay, so why does this whole market exist? What's its purpose?
It really has two main jobs, two key purposes. For companies, it's about raising money, what we call capital formation. They sell shares, often starting with an IPO, an initial public offering, to get the funds they need to, say, expand or invent something new. Think of it like large-scale crowdfunding.
Right, funding big ideas.
Exactly. And then for investors, people like you, it's about wealth creation. You're putting your money in, hoping the stock price goes up, or maybe you get dividends.
Dividends, right, those regular payouts.
Yeah, some companies share a portion of their profits that way. So capital for companies, wealth potential for investors, it's a two-way street.
Okay, so it fuels companies and potentially grows your money. Makes sense. But how does it all work? Where does the buying and selling actually happen?
This happens on stock exchanges. You've probably heard of the big ones like the New York Stock Exchange, the NYSE, or NASDAQ. These are basically giant marketplaces, highly sophisticated, connecting buyers and sellers from all over. And for most individual investors, you get access through a broker. These days, often an online platform, which has really opened things up for everyday people.
Ah, okay. And I've heard about primary and secondary markets. What's the difference there?
Right, that's an important distinction. The primary market is where brand new shares are first sold. Think IPOs again. The money from selling those new shares goes directly to the company.
Okay, primary means new.
Exactly. Then the secondary market, that's where shares that have already been issued get traded
Mm,
between investors like you and me. So the NYSE, NASDAQ, that's mostly the secondary market. And this is crucial because it provides liquidity,
liquidity,
meaning the ability to easily buy or sell your shares. If it was hard to sell, fewer people would buy in the first place, right? So the secondary market makes the whole system work. It makes it easier for companies to raise money in the primary market.
got it. So the trading between investors is actually vital.
Hmm.
Okay, but what makes prices jump around so much? It sometimes feels random, not just based on how well a company's doing.
Yeah, it can seem chaotic. It's definitely a mix. Obviously, company performance matters. Things like earnings, growth prospects, how expensive the stock looks using ratios like the PE ratio, that's foundational. But then you have the day-to-day stuff, simple supply and demand. How many people want to buy versus sell right now? That's reflected in the bid-ask spread.
Okay, fundamentals and supply demand.
And then there's the bigger picture. Economic news, interest rates, inflation, even just general market mood or sentiment.
Hmm.
But here's a really key point. The stock market is often seen as a leading indicator.
Leading indicator, what does that mean?
It means the market tends to move before the broader economy does. It's constantly trying to guess or discount what's going to happen, say, 3, 6, even 12 months down the line. So market movements can sometimes tell you more about where people think the economy is heading rather than where it is right now.
Huh. That's fascinating. So it's like a crystal ball, almost,
Yeah.
predicting the future.
Sort of. A
Mm.
very fuzzy, often wrong crystal ball, but yes, it's forward-looking. Which brings us to, well, what does this all mean for your money? The rewards and, importantly, the risks.
Yeah, let's talk about that.
Well, the potential reward is significant long-term growth. If you look at history, something like the S&P 500 index has averaged around 10% per year over many decades. That includes the crashes and bumps along the way. Compounding makes a huge difference over time.
10% average is pretty compelling.
It is, but, and this is a big but, you have to accept the risk. Volatility is part of the deal. Prices go down, sometimes sharply. Market corrections, even crashes happen. Losing money, losing your principal is possible.
Well, no guarantees.
No guarantees at all. So the key principles for managing this. First, think long term. It's often called time in the market, not timing the market. Trying to jump in and out usually doesn't work well. And second, diversification. Don't put all your eggs in one basket. Spread your investments across different companies, maybe different industries or even countries. Things like mutual funds or ETFs make this pretty easy to do.
Okay, so to recap, a stock is real ownership. The market helps companies grow and helps you potentially build wealth. Trading happens on exchanges, mostly the secondary market, which provides liquidity. And prices move based on performance, supply, demand, and importantly, future expectations. And for your own investing, the watchwords are long-term focus and diversification.
Exactly. And maybe the final thought to leave you with is just how interesting that forward-looking aspect is. The market isn't just reacting to today's news, it's constantly trying to price in tomorrow's possibilities, tomorrow's autonomy. So next time you see the market jump or fall, maybe ask yourself, what future story is it trying to tell right now? It definitely changes how you might look at the financial headlines.